All right. We'll let everybody get in. We are right on time today. I always like to have a little bit of fun with some kind of icebreaker questions while everybody gets in. And one of my most favorite questions to ask people, and we'll start, Matt, with you. One of my most favorite questions to ask people is why and how in the world did you get into mortgage? Because I have found that people really intentionally do not necessarily go to school for mortgage, and
Sure.
would love to maybe hear your story as we get everybody settled in here.
Yeah, I was saying earlier I studied economics in college, and I remember going to professor when I was a senior in college, graduating, and wasn't sure what I wanted to do. And I asked him for advice. He was my professor for a couple classes, and I'll never forget his answer. He said, "How am I supposed to know I'm a professor?" So I was like, "Oh boy, I'm on my own here with my economics degree." So I have a sister that went to school for finance. He was in the mortgage business. I still work with her today. She's our COO of the mortgage company, and started sort of followed her footsteps and started working with her back in 2003, and worked with her. And gosh, there's a group of probably about 20 of us that have worked together almost continuously since that point. So it's been great.
That's very cool. Um, all right, Rob. I don't think we've not had you share this before. So why and how in the world mortgage? We'll have a little get to know Rob Chrisman moment today.
I saw there was a matchbook and it said, draw this donkey and it's mail in your drawing to this address. And I did that, and a letter came back saying you'll never be an artist, but you might be better suited for mortgage banking.
Okay,
Rest
that's
is history.
completely appropriate.
Do they even have match books anymore? I don't even know.
I think so.
I
They
have a
used to
Matchbox
be
collection.
away at restaurants, but I've not seen them in quite some time.
Yeah.
All right,
Anyway,
well, at least we know there's one thing that Rob Chrisman is not great at, and that apparently that's drawing.
I do
Just
okay.
not donkeys. Yeah, just not
Yeah,
donkeys.
no, I
Just
was an
not
architecture major. So anyway, we're really digressing here.
You
People
are
are tuning in
digressing.
to hear about me being an architecture major.
I had no idea you were an architecture major. Then you can totally draw.
No, I switched out of architecture into food science.
Okay. All right. We did get way off topic. I'm sorry. We're gonna get back to mortgage, I promise. Welcome everybody. Thanks for joining us this afternoon. I'm Melissa Langdale, the President and COO of the Mortgage Collaborative. Excited to see everybody that's here with us. As always, joined by Rob Chrisman, and this week's special guest is Matt Nyman of Mutual of Omaha Mortgage. He is the SVP, the Director of Secondary Markets. So Matt, thanks for joining us today.
Thanks for having me. I appreciate the opportunity.
Absolutely. And I know I mentioned obviously that I'm with the Mortgage Collaborative. I got to do a little bit of a plug because we do have a conference coming up in Louisville, Kentucky. For those that were not a part of a first few minutes of a rundown a couple weeks ago where we were talking about it. It is at the end of March. We are 30 days from that event officially today. So excited to be able to see everybody in our TMC family in just another couple of weeks. And we've got some fun things like a bourbon tour. We've got a Louisville Slugger Museum reception, and of course, lots and lots and lots of fantastic content. Mark McCardle, Sandra Thompson, Julia Gordon are going to join us. And of course, Rob will be there as well, and myself. So look forward to seeing everybody. Elena, hey, I'm excited to see you too. So we'll see everybody in Louisville, but let's go ahead and kick things off for the rundown today. Matt, I think it would be helpful for everybody. I think there's probably a general awareness of who Mutual of Omaha is, but maybe give everybody a little bit of a rundown of what's unique about kind of Mutual of Omaha Mortgage.
Sure. So I came to the organization just about 5 years ago. We were acquired by Mutual of Omaha Bank, which was a separate entity from the insurance company. And we had, our group had started a helped start a mortgage company for a local bank in the Chicagoland area. Grew that up over time. The owners of the bank, I think, kind of got exhausted with banking and mortgage in general, and decided to sell the mortgage group, and had let us know that they didn't, like, the buyer had no interest in mortgage. So we were in a tight spot. We had to find a buyer for our mortgage group. We had about 300 originators, mainly a consumer direct operation, but we're doing about $2 billion a year in production. And we were introduced to Mutual of Omaha Bank through Synergy One Lending, who had just been acquired by the bank. So it worked out really well. We had a very short time frame for the acquisition. The folks at Synergy One are great. Leadership team from that group is still with us today. So they had just been through a long acquisition with a big company like the insurance company or the bank. Typically, the due diligence needed to make a transaction like that work would take a very long time, but we were fortunate that we were on all the same systems as Synergy One was, at the Compass and Optimal Blue and different things like that. So it worked out well. We were able to make that transition go smoothly, and we were acquired by Mutual of Omaha Bank. Shortly after joining the bank, we found out that they were up for sale about a year into that transaction. But what was interesting was the insurance company really liked our model. And with the insurance company, I'm not sure if everybody knows, but they view our business as a hedge against their business. So when interest rates are low, they don't necessarily do great because they have to keep so much cash reserves. And when interest rates move up, they tend to do better than what you see in mortgage. So they saw that there was a natural hedge to the business there. And even though the bank was for sale, they liked our business, so they wanted to keep our business aboard. So we moved over to the insurance company. Some challenges there. We had to get all of our originators licensed because we worked for a bank, and now we didn't. But we worked through that challenge, got everyone moved over and licensed, and everything was going great. And then COVID hit. So we've been faced with some challenges for the last several years, but we found a way to work through all of them, and have a wonderful parent in the insurance company, and feel very fortunate for where we're positioned in the marketplace for sure.
Well, let's talk about that a little bit. I think there's, one of the things I always tell everybody is if you're in the mortgage business long enough, the one thing that you can always count on, and the one thing that you end up perfecting over your career, is the art of the pivot,
Yeah.
right? As much as our industry changes, and, it is in a lot of cases having to respond to the things that are happening around us. You end up kind of perfecting that over time. You know, we have a lot of changes happening right now. Obviously, during COVID, there was a lot of volatility for a lot of different reasons. But over time, we've seen product mix changes. We've seen, just recently within our industry, we've seen some cybersecurity incidents. As you think about that in reflection of your role, just the general kind of volatility that happens when big things like that shift in our industry, how do you approach it? I'm thinking about like your hedge position and all of those sort of things that happen behind the scenes. What are some of the ways that you try to guide your LO team and your company through those shifts?
Yeah, one thing I think that really struck me, I would say it's probably been about 2 years ago, but you'll hear all the time that we're in unprecedented times, right? That's what unprecedented times in the mortgage industry. We hear that same thing year after year. And the reality is that there is no precedent for what's going to happen this year or next year, right? Like I keep saying I'm waiting for a quote unquote normal rate market, a normal mortgage market. Well, I've been in the business for 20 plus years, and every year seems to be different with a different set of challenges. So I think the reality is that every year is going to be different, and you just need to expect that. But in terms of pivoting and managing through different challenges, I think COVID was such a great learning experience for myself and for our leadership team. I mentioned to you earlier, what we got a message, I think it was about 2 days before they kind of shut the whole country down, right? That we needed the departments had to prepare a plan of action if we were to go fully remote. And I was like, this is never going to happen. That's not who we are as an organization. Culturally, we kind of show up through thick or thin and get the work done. And sure enough, 2 days later, we were fully remote, and we thrived during that time frame. I think that obviously volume spiked and things like that, but we became so much more efficient. I think during that time frame, and what I would have considered to be a really big challenge. But you can be very prepared for events, but until you know what you're dealing with, I think that's when the rubber hits the road, and you learn how to work through those challenges with products disappearing, like the non-QM market really drying up. During that early parts of COVID, that was a huge challenge. And how do you pivot from that? And what do you do with those loans and different things like that? So, you're going to see different things come up every year, but you just use your experience that you've gained throughout the years and figure out how to move forward right there. It's one of those things, especially in this industry, that you're always finding solutions. You're going to always have problems. It's part of the business. It's part of what we come to work for every day, especially in a operations or support role for those sales folks, right? We want them selling, so our job is to support them, and support oftentimes means cleaning up messes or dealing with problems. And that's really what I view my role as, is just somebody to help a loan officer clean up the mess that may come aboard from no fault of anybody, right? Just part of the market.
Yeah. I think, what are you, speaking of loan officers and your ability to help them navigate those challenges, what are you telling them about what's really moving rates right now? Obviously, there's a lot of discussion about sometime this year there's going
Sure.
to be some rate relief, but we haven't seen it obviously over the last week. So how are you helping them to navigate that discussion with their borrowers, their referral partners?
It's really interesting in the current rate environment, where we're not that much different in terms of note rate than we were maybe 6 months ago, 8 months ago, a year ago, right? But I think what happens is that consumers and loan officers become comfortable with the rate that's available. Like, you go through this period of ultra low rates, they move up quickly. There's the shock that comes with that, and everybody kind of steps back and goes to the sidelines. I think what we're seeing now is people are comfortable with where the rate market is at, and are we going to move a half a point lower, maybe a quarter point higher, maybe, and you'll see fluctuations from day to day. But for the most part, people understand, and okay, this is the new normal when it comes to interest rates. In terms of what's moving it, I think a lot of it is expectations from the market. I follow several different sources. We get a lot of commentary from broker dealers daily. The Bank of Oklahoma group sends out a great daily email to secondary folks, and Chris Maloney, I think, is a very good resource there. He called for a very maybe worse than what we're seeing now, first quarter, first half of the year. We're not quite as bad as what he thought it would be, but he's pretty darn close, and I think that he has a good tune for what that rate market looks like. But I would expect rates will probably move a little bit lower the second half of this year. Everybody was excited for the first quarter of this year. I didn't hold that same opinion. I kind of, like, where we're at is kind of where I thought rates would go. But we are very interest rate sensitive. When we saw that little move down in rates we had 6 weeks ago or so, our pipeline swelled and business came in. So I think consumers are on the sidelines ready to make a move in both purchase and refinance space, which is encouraging. It's just, at this point, like you said, a matter of time. I do think that rates will move lower. Nobody can tell you when that's going to be. I wish I could, because I would be on a boat somewhere when doing this call. But outside of that, it's just a matter of just dealing with what you're given on a day-to-day basis.
Rob, did you bring your magic 8 ball to Reno with you?
Crystal ball that I saw in an antique store 6 or 8 weeks ago.
Yeah. Yeah.
No, I agree with Matt. If we used to say, gee, if I knew where rates were going to go, and you think I'd tell you, if I knew where rates are going to go, I'd be on a beach in Moorea or Bora Bora or someplace, just hanging out, and then you quickly realize be bored sitting on a beach mat, probably. Uh, so yeah, I would agree, and so much of the market is expectations. What tends to move rates, as Matt will attest, is when something surprises the thinking, and oh, everybody thinks the market's going to zig, and instead it zags. Everybody thinks unemployment is going to do this, but it does that. And right now, the expectation, I saw Goldman Sachs. They not that they have any great knowledge that Matt doesn't have, but they don't see a Federal Reserve rate cut until June, I think it is. So that whole thinking has shifted out, and the famous expectations of recession have yet to materialize. The job market is doing okay, the housing market is doing okay, the consumer is still spending, and as you and I have talked about, Melissa, you can torture the data and find something recessionary or something inflationary or something to support your way of thinking. But overall, things are going okay, And so when things are going okay, we're probably not going to see much of a rate decline. So rates kind of seem happy where they are now. And I hope folks are used to that. I still think there's overcapacity in the workplace. And Matt, I wanted to ask you to mention, I mentioned the workplace there. We still talk about the pandemic, which right now is, 3 or 4 years ago. Has everybody in your office come back to the office, or have you incorporated or instituted some kind of hybrid work arrangement?
Yeah, it really it kind of depends on to some degree the role and responsibility you hold in the company, and then how that's managed by the branch level. So from an operational standpoint, our underwriters, even before the pandemic, were pretty much remote for the most part. It was we happened to be going through an office remodel just before COVID, so we were taking on more space and doing a build out. So we had a lot of people working remotely for that build out, and then we did this giant build out, and COVID hit, and nobody came back. Right, so we had expanded to house all these folks, and then it just kind of wound up that nobody came back. We had a lot of people that chose to move to different parts of the country and different things like that. So I would say for the most part, our sales folks tend to work, especially in the consumer direct channel, they tend to work in an office space. And then operationally, it kind of depends, but more of a hybrid model from there. Myself, I go into the office 3 to 4 days a week right now. I do enjoy not making the commute at least 1 or 2 times a week, which is a nice benefit that we picked up after there. But honestly, I find that the hour and a half I would spend commuting, I spend working now. So it does help with some efficiencies and things along those lines.
Does anybody, probably no one under the age of 50 or 45 or 40, remembers Marlin Perkins and the Mutual of Omaha Sunday afternoon show about Marlin was out there with Jim
Yeah.
hunting, watching zebra
Wild
be
Kingdom. Yeah.
well, the Wild Kingdom. Is that, I mean, when you talk about the name Mutual of Omaha, it's a mutual bank, right? Is that, I mean,
Insurance company.
what is the origin of Mutual of Omaha's name?
Yeah. So actually, for Wild Kingdom, just a quick plug there. We're actually they brought that back. So they are streaming some episodes of Wild Kingdom. They're sort of trying to bring that brand back. I think that they're streaming it some online, and then a few TV networks are carrying the show. So that's a recent thing that they've brought back.
Wow,
But
I didn't know that. I gotta peel away my cat Myrtle from TV when Big Cat Diary is on. But anyway, so I'll
yeah.
have something new to watch.
And then the name mutual, so it's a mutual insurance company, right? So what that means is that it's not a publicly traded company, that the policyholders of the insurance company all have ownership within the company, which it's a mutual company. So it's the ownership structure would be that the policyholders are basically the quote unquote shareholders if it were like a publicly traded company.
So people always ask me, when I walk into the supermarket, they look at me and they say, So who's the natural buyer of a mortgage-backed security? And that always catches me off guard. But I just made that up to some extent, but it is a question about who wants to buy a 30-year mortgage, and usually it's insurance companies or pension funds.
Mhm.
And do you find that given that you're an insurance company, in effect, I mean, are you able to offer products to your originators that say a small or mid-sized independent mortgage bank cannot offer because it's like you are part of the organization and that organization may want jumbo loans or adjustable rate loans or whatever you might want to originate?
So that's something that we've really been working on since day one, it being acquired by the insurance company. So we're a separately held subsidiary of the insurance company. So they can't purchase loans from us right now. They don't have like the licensing ability to do that, but that's something that we've been really working on from day one, for the ability to be able to offer a portfolio product or to sell securitized loans directly to them. So that's something that we really work on all the time, and we're trying to figure out different ways to do that and efficient ways to do that. Well, they do buy sort of mortgage product on the back end from their insurance group. What's really interesting about the parent is that it's run by actuaries, right? So it's a little bit different than, I've worked for banks in the past. We've worked for private equity, different things like that, and every management style tends to be a little bit different. But this is very unique in that the ownership structure, it's not what you would, it's not I don't know how to say it the right way. It's not like what you would think a typical business guy would be running it, like a typical CEO, right? They are, all of the leadership of the insurance company are actuaries, so they think about things very analytically, and think about things a little bit differently than maybe a typical CEO would, or a CFO, something along those lines. So while we're part of the company and we're part of the mutual family, their number one priority is to their shareholders. So while it would be maybe beneficial for us as the mortgage company to be able to sell them a product that would help us in the long term and have a portfolio product for our loan officers or something out there that's unique to the street, if that doesn't mean that it's the best return for the shareholders, they wouldn't be interested in that product. So it's something that we continue to work through to find a good way that it could help our business, but then also help the mutual brand and the name in itself, so that the shareholders are benefiting to the best of their ability as well throughout that product.
Now
Interesting. Oh, go
go ahead.
ahead, Melissa.
You do have quite a breadth of products that you offer, though, right? You
Yeah.
have renovation, you even offer reverse, you have, down payment assistance, all of those kind of normal conventional W, type of products as well. So, I'm curious, like, as you look across that whole gamut, right? Reverse number one is, I know, a separate kind of beast in and of itself, but
Mm-hmm.
of all the products that you guys offer today, like, what's your most difficult to manage? Either from a hedging perspective or just in general, I'm curious what you find is the most challenging.
Yeah, I would say most challenging, two products come to mind. One are DPAs, not because they're necessarily difficult to underwrite or things like that. I find the challenge with the DPA are, one, being able to offer those products to originators, especially when we're bringing on a new originator that's maybe a market that we haven't had much success in before, and we don't have, when you're looking at DTA, you look at it from the state level, the county level, sometimes maybe even the city level. Approvals for those agencies is very difficult, right? Oftentimes they're going to want to have some sort of volume commitment annually. So you want to be able to offer all those products, especially in a small market like that, where maybe a retail originator's got great relationships with a realtor in that area, and they need to be able to offer that product. So managing that approval is difficult. Second is getting those loans sold. Typically they take a little bit longer to buy than what if we were to sell to an investor. They're not that profitable, right? So I mean, you have a couple of challenges there. You have a higher sense of expense with those products because you're holding on your line longer. They don't typically pay a lot of premium. You have a lot of time invested in getting those products approved, but it's one of those products you have to be able to offer, right? So we do a really good job at that. We have a wide selection of products that we offer there, but it is a challenge. And second is the non-QM space. I am excited to see that the non-QM is kind of, up until I would say the last several years post-COVID, right? It's been one of those products that every year you feel like it's going to be the year that this product gets traction and is here to stay. And then something happens and that market would always sort of dissipate and they'd start over the next year. And the non-QM does seem like it's here to stay now, right? Like, which is encouraging. I think the next natural progression that we need to see there to make that product really viable is just sort of a consolidation of the guidelines. You know, we have so many outlets for non-QM, but everybody seems to have their own little niche or their own little product guideline difference. So it just makes it difficult if one investor won't buy it to make sure you have a second outlet for that product. So I think we're getting to that point right now. It seems to be a consolidation there, especially in the guideline space. But once that, you know, gets a little bit more in line with what we see on the conventional side, I think that will really help with those products to take off.
Yeah, you talk about bond programs. You know, there was always, when I was running capital markets, there was always you always get the head of production saying, "Hey, you know, I want to hire this loan officer, but we need this Rhode Island bond program," and then the LO will come on board, and I would think, "Oh, gosh darn it, you know, another, you know, Rhode Island. You know, how many of these loans are we going to do a year? You know, a month? What is the cost to bring on a program versus how many loans we're going to, you know, what kind of money we're going to make on that?" So it's yeah, it's interesting what is difficult and what isn't difficult. And when you talk about, you know, what kind of products work and what kind don't, you know, the vanilla stuff, Fannie Mae, Freddie Mac, FHA, VA is still, you know, the lion's share. And I work that lion's share. You like that, Matt? Lion's share. Your
Yeah,
background
I
as a
do.
lion. You
Yeah,
like that?
yeah, yeah.
Is still the lion's share of the business. Are you dealing with a lot of renegotiations or extensions right now? How do you handle those?
Extensions don't typically are not, they haven't been a big issue for us. So extensions are okay. Renegotiations right now aren't really an issue, but they were, you know, probably 6 weeks ago, right? When rates moved dramatically. You know, renegotiations are tough. We have a policy in place for it. We do our best to stick to that policy. You know, because you have to have something, some sort of basis of a guideline to go off of. I think what the sales folks don't always understand when you're hedging a pipeline is that when you do renegotiate, more often than not, there is a real cost to that renegotiation, and it likely comes out of corporate margin. And in the last, you know, 24 months, margin has not been something that there's a lot of to go around, right? So you're already dealing with compressed margins. But part of it is just, you know, I think my philosophy's changed a little bit over the years, especially now in this market. And really what we've tried to do as a leadership team is really recognize that what we've tried to do the last 2 years is keep the team together, right? Like keep people busy, keep them engaged, keep our sales folks winning deals. And if we have to make a concession on a renegotiation, it's better to make some money than no money, right? So our policy is in place so that we really don't want to float down or renegotiate a rate until it's clear to close. By that point, we've invested a lot of time operationally and money in the underwrite, credit pulls, things like that. So yeah,
We lost Matt there.
Yep, there we go. So it's just one of those things where we just look at it on a case by case basis, but recognize it is sort of a cost of doing business, and stick to our policy as much as we can, and just do deals that make sense.
Yeah, teamwork. Yeah, I think Ira Selwyn is also on this call. He's a secondary marketing guy, and every time I talk to him, he goes, "Rob, remember, you know, teamwork makes the dream work."
Right.
Thanks, Ira. Thanks for that.
I love it. All right, we have time for one more question. Rob, do you want to finish this out?
One last question.
Yeah.
Look, Ira chiming in. Um, Matt, who's the most famous person you've ever met?
Ooh,
That's a good question.
While you think about
Uh,
that, Melissa, you need to talk about the hotel block for the Kentucky event. You
oh,
know,
that's right. I talked about the event, but I didn't talk about the hotel block.
yeah.
Yeah, so today is actually the last day where you can get a discount as a part of our group rate. If you are planning to register for Louisville and have not booked your hotel, you need to do it today. Otherwise, the prices are going up pretty drastically. So those of you that have not booked your room yet, make sure that you get that taken care of soon. Thank you for the reminder, Rob.
You'll end up with me down at the O'Connell Lodge down the street. So Matt, who is the most famous guy you've ever met?
yeah, I had the opportunity to meet. I don't know how. I mean, I guess he's famous in my mind. Maybe I would consider him to be one of the greatest athletes of all time. But Bo Jackson, I met him at a golf event that we had several years ago. Was a very just great guy, very genuine guy. Was always amazed by his athletic ability when I was younger, dual sport athlete as a professional. And I had the chance to meet with him and talk to him a bit, and that was a neat experience.
He didn't break a golf club over his knee or anything,
No,
did
no, he was very, he was very low key. Didn't seem to be too upset on the golf course. That's for sure.
he? Good.
Rob, how about you? Who's the most famous person you've had the opportunity to meet?
Besides Ira,
Yeah, besides Ira, of course.
there's different ways of meeting people, right? You can shake somebody's hand and then in a receiving line, I met Gerald Ford that way. But to hang out with would be, Ronnie Lott. You talk about athletes, Matt, Ronnie Lott, very, very nice guy, very down to earth and, you could tell he's very, very competitive. There's something about him that the competition runs in his blood.
Yeah,
So
It's very
I'm
cool.
always
Melissa,
shocked
Ronnie
when
Lott
you.
was played for the San Francisco 49ers back many
Thank you.
years ago.
I did actually need a lot of help. I was going to Google it after this. All right. Well, we are right up at time. Thank you everybody for joining us. Happy Friday. We look forward to seeing everybody in Louisville in 4 weeks, right at 30 days. Super excited about that. Matt, thank you so much for joining us, for sharing all of your expertise with us. Really appreciate it. And hopefully we'll see you in, if not Louisville, maybe in Denver. All right, everybody, have a fantastic weekend and we will see you next week.
Thanks so
Bye.
much.
Thank you. Thank you, Matt.
Bye bye.
Bye.